Hi, and welcome to another episode of Comstock Mortgage Money Tips, where you'll discover insider secrets on how to save time, energy, and money when buying, selling, refinancing, renovating, and maintaining your home. This episode is brought to you by Carl Self of Comstock Mortgage, the #1 mortgage choice for Seattle and Washington State homeowners. Now, here's your Comstock Mortgage Money Tip. Today, more than any other time in our history, many Americans find themselves bogged down with bad credit rating for the wrong reasons. Illness, losing a job, or simply not understanding consumer credit. Sometimes bad financial situations happen to good people, and bankruptcy is the only way out. But it's not all doom and gloom. There are a number of strategies for putting your credit back on track and getting approved for a mortgage loan, even after a bankruptcy, foreclosure, or short sale. Going from one financial institution to the next, if you've done this, only to be declined again and again, can be very frustrating and disheartening, which is where an experienced mortgage consultant on your side can make all the difference in the world. Here are a few factors to consider. Factor 1. Locating the right lender. Some lenders will not approve a mortgage loan if the bankruptcy, foreclosure, or short sale shows up on a credit report. However, so-called non-conforming lenders, such as mortgage banks or brokers, may consider doing so, provided the borrower can demonstrate that he or she has the income to support the payments and is now currently a good credit risk. Factor number 2, length of time since the bankruptcy has been discharged. Different lenders have different criteria regarding the length of time since a bankruptcy, after which they will grant a mortgage loan. Typically 2 years along with proof of reestablished credit is required. Some lenders may consider applicants with a more recent bankruptcy with mitigating circumstances such as a medical incident or loss of job. A professional mortgage consultant can advise you on the regulations of the various lenders. Factor number 3, reasons for the bankruptcy. If a bankruptcy was due to factors beyond your control, this is more acceptable to the lender than if the bankruptcy was the result of poor money management and excessive debt, which can affect the terms of an applicant's mortgage approval. Factor number 4, size of the down payment. The size of down payment required after bankruptcy depends on the type of loan program which you are applying for. For example, FHA loans require down payments in the range of 3.5% to 5%, while conventional loans require a slightly higher down payment. Keep in mind, the higher you can make your down payment, the lower your interest rate will be. Factor number 5, credit report. A credit report is a detailed history of how consistently your financial obligations and debts are met. It provides a picture of financial health based on your past behavior. You can obtain a copy of your credit report from Experian, Equifax, Innovus, or TransUnion. Factor number 6, credit score. A credit score is an objective summary that translates personal information from a credit report and other sources into 3-digit numbers that represent overall credit worthiness. A borrower's credit score may determine the rate of the mortgage. The higher your credit score, the better the rate, which can be negotiated. Some lenders have a minimum credit score requirement for those with the bankruptcy. Factor number 7, rate considerations. Most lenders charge a higher interest rate and even some extra fees to those with bankruptcy. A lender may grant a better rate if certain lending criteria has been met, such as 2 years since a bankruptcy discharge, good reestablishment of credit, a credit score above the minimum level, saved down payment, good debt ratios, long-term history of job stability, and compensating factors as to what caused the bankruptcy. Factor number 8, reestablishment of credit. Reestablished credit shows that the lender, that a prospective borrower has new credit and has managed it well since bankruptcy. Typically, reestablished credit should involve a recent record of on-time payments on major bank or credit cards. When rebuilding your credit, you need to be aware that a missed payment at this stage could be grounds for most lenders to decline a mortgage application. At this point, it is paramount that you pay your debts on time to reestablish credit. Factor number 9, don't do it alone. As your mortgage professionals, we can coach you on how to improve your credit score over time. While you work on bettering your score, we can advise you on how to get a mortgage despite damaged or bruised credit. If you or someone you know has gone through a bankruptcy, take heart. There is hope. For a free, no-obligation consultation on how to get approved for a mortgage after bankruptcy, foreclosure, or short sale, call us today. Thank you for tuning into this episode of Comstock Mortgage Money Tips. If you have any questions or comments, please call Carl Self today at 206-307-2754. You may also contact us on the web, seattlebestmortgage.com. Go to our contact page, fill out the form, and reply electronically. Thank you very much, and have a great day.